the magic math behind buy, borrow, die. And this is for the average or high earner, retirees, or those planning retirement, or even those that are, in mid-career and thinking about retiring or getting out of corporate America, or even the youngsters, right? So how's it going, everyone? My name is John Howard, and in this video today, I'm going to cover this subject of the magic math behind buy, borrow, die. And the reality is buy, borrow, die is rather popular. I've kind of, been doing some, quite a bit of postings on LinkedIn and noticing that the buy, borrow, die subject is, or theme, I should say, theme, subject, whatever you want to call it, is rather popular. It's something that is also, in the media. I've seen other kind of real estate influencers talk about buy, borrow, die quite a bit. And it's really a rather attractive thing to consider, if you are considering becoming an investor, primarily if you're considering becoming a real estate investor. All right, so let's dive into buy, borrow, die. Almost everyone watches nearly half their paycheck go to taxes, but there's a powerful strategy people with assets use that combines strategic borrowing with income producing and high ROI assets. It is important to find assets with historically proven returns. Short and midterm rentals are an investment vehicle that accomplish on average, roughly a 7.5% annual return with only two of their benefits. When you purchase a rental property, multiple forces work simultaneously to build your equity. You have appreciation, which, on average is 4% annually. U.S. national appreciation was 4.24% from 1967 until the end of 2024. In fact, also, if you actually look at the Case-Shiller National Home Price Index, which was 309% from 1995 to 2025, so those 30 years. And again, that's, when you factor in a 10% down payment, that's actually a 3,090% return. But if you keep it simple, let's just say, okay, on average 4.24%, but let's just keep the math even simpler than that and say it's 4%, right? Then you've got amortization, which on average is about 3.5%. Amortization is going to be a little bit different because what happens is you pay a loan down, the bank is going to have their own formula for that because at the beginning you're paying a lot of interest because you have the principal, but as time goes on over 30 years, you're going to be paying a lot more amortization, a lot more of the loan down, and you're going to be paying a lot less interest. Naturally, you're paying the loan down. So what the bank and the mortgage company like to do is they like to keep your payment consistent, so you know that you always have like a $2,000 payment, and then it's mixed between amortization and appreciation. To keep the math simple, we're just going to say it's on average about a 3.5% annual figure, and that's because you just take your mortgage balance and then you divide it by 360, even though that's not what it's going to be. But let's just keep it simple and say an annual 3.5%, annual figure. With a good loan, you are paying down your loan in 30 years or 360 payments. And when tenants or guests pay rent, this pays down your mortgage principal. Combined, this is 7.5% annual growth on the asset. This 7.5% return on the asset is only two of the benefits. The investor also gets monthly cash flow, massive tax deductions, and the ability to borrow against the equity as it grows. This is tax-free liquidity access, and simple figures to use is, let's say, 2% a year of your rental property value annually, right? So on a $500,000 property, an investor is building roughly, let's say, $37,000 of equity annually without considering cash flow or tax benefits. This 2% is only $10,000 roughly annually. But if the property performs, the investor can acquire more properties by leveraging its equity. If the investor puts down 10% or $50K, this $36,887 is a 71.5% annual return. Via FHA, so FHA is Federal Housing Administration, and that's where you can put a 3.5% down payment down. That's $17,500 or 3.5% down. This is a 211% annual return. And again, that's just factoring in just the benefits, right? The investor can deduct property expenses and paper losses against income, generate monthly cash flow, and access tax-free capital through strategic borrowing. The strategy is also powerful for those planning retirement. If you're transitioning, or any of us are transitioning away from W-2 income, the material participation requirement, which, the shallowest requirement is 100 hours or more annually and more participation than anyone else, becomes much easier to meet when you have more time flexibility. And the tax savings can significantly extend the life of your retirement portfolio while building lasting wealth. Buy, borrow, die works because you're stacking a 7.5% annual return on the asset. Equity return is much higher, with tax advantages, cash flow, and liquidity that few other investment vehicles can match. So there you go. So basically, the concept is, if you need liquidity and you're going to go and you could go and go get a HELOC, and get some cash, or you get an equity loan. I mean, ideally, you don't want to be going and getting cash, right? Just for the sake of getting cash from your properties, because you're taking on a loan, you're spending. You want to do that to then buy more, property, right? But the point is that if you go and get a loan, the proceeds from that loan are tax-free. They're not taxed. It's not like it's earned income. It's you're able to access that money tax-free. So that's one of the key reasons that buy, borrow, die, makes sense. So if you actually think about those numbers from that perspective, you've got a $2 million rental portfolio, it might be, giving you like, $135,000 of annual wealth growth. And that $135,000 never even touches your bank account. Some might say that that's not good, but at the end of the day, it actually is pretty good, because if you have a $2 million rental portfolio, which, might not be that hard to achieve, that's still a fairly significant amount of money that you're growing your wealth, that you could, continue to borrow from if you want to, or you continue to leverage to buy more property, or continue, or pass to your heirs, in terms of the way that when you pass things to your heirs with respect to real estate, the actual value steps up to its to what the value was at our passing, right? So there you go. If you have any questions about the buy, borrow, die, feel free to put your questions, or I encourage you to put your questions in the comments area. Again, my name is John, and I've kind of been doing videos on this because, like, for me, I've been doing short and midterm furniture rentals for literally the last 2 decades. And during that time, I actually launched and operated 4 different businesses that all went up to 7 figures or more annually. I actually never had an exit with one of those, with one of my non-real estate businesses. But basically, the reality is I bring that up because that's part of my experience, but also, someone that is, let's say a high income earner, or a high powered executive, or a doctor, or some sort of a high income earner, you can, certainly build an investment property portfolio alongside of your career. In fact, you're going to be the best suited to do it because you're the best and most qualified to actually get approved on the mortgage. Now, if you're somebody that doesn't have good credit and you don't have a lot of income, you could still do it. You just need to work with partners to actually grow your portfolio and then take a percentage of your deals. For me, in my case, I mean, like I mentioned, I didn't have an exit with one of my non-real estate businesses, those businesses that I launched. But during that time, I actually owned and operated 5 different, short and midterm rentals. So and that's during a very, very busy entrepreneurial career. So it's very doable, for anyone to do it, and, however involved you want to be, or if you want to kind of outsource everything. And, with real estate investing, one thing I've come to appreciate is that it's one of the few investments where you get multiple benefits, actually 6 benefits from one investment. Those are appreciation. I covered that a little bit in this video. Basically, the Case-Shiller index is 309%, 1995 to 2025. And if you factor in a 10% down payment, that's actually a 3,090% return. You're actually, in that example, you're beating Warren Buffett, who doubles the S&P 500 every year. S&P during that same time frame, Case-Shiller, 1995 to 2025, did 1,008%. Or 11x, and then the actual NASDAQ did 2,111, which is 21x, and then, again, Warren Buffett doubles the S&P, so he did 2,116. So Warren Buffett 21x, NASDAQ 21x, and then the S&P 500 11x, over 30 years. So you're actually beating all those, S&P 500 by 20x, and Warren Buffett and the NASDAQ you're beating by 10x with just appreciation. And then you also get, rental income and cash flow. And if you actually look at that, like for me, I've been able to, pretty much, even with the just two, I've got my third property actually I have a partial interest in, but even just the two that I own myself, those have done about 150,000 per year in booking revenue for the last 10 years plus, right? And if you actually take a look at it now, they do between 10 and 38,000 per month on average, in booking revenue. And there's multiple months in a year where there's $20,000 in booking revenue. So it's definitely something nice to have in the mix. And then fast forward, it's like, okay, well, it's their property values are about $3 million, and then I was able to get 2.875 30-year fixed mortgages during the pandemic. So, from the perspective of like long-term wealth building, it's a very good strategy, and also a very good strategy, for retirement. If any of this sounds good, again, you basically, like I said, you can consider giving the video a like. You could also consider subscribing to the channel. I talk about more than just real estate. I also talk about investing, although I haven't been investing for a while, and then talk about other things too, like I'm an active living enthusiast and also a proud dad. So I'll talk about other things on my channel. But I also have something called the SMTR Launch Kit. You'll see that in the links in the video. And it says short, medium-term rentals, short and mid-term rentals. It's a launch kit. Again, it's very inexpensive if you want to check it out. And in the event that you want to get into real estate investing, you want to check it out, you can work with someone that is more of an expert than you, right? Just someone that's more of an expert I've been doing it over the last 2 decades. And and then if you know somebody, maybe not yourself, if you know someone that wants to get involved in real estate, you could forward them this video. I also have very inexpensive email coaching if you want to take it a step further other than just getting the kit. And again, these are all very, very inexpensive, nothing fancy at all. Other than that, if you have any questions, I encourage you to put them in the comments area, and thank you very much.